85% fundamental, 15% technical. And I created the model because self-directed investors didn't really have the tools and the discipline to successfully manage their own money.
And that's created by famous analyst and entrepreneur Marc Chaikin.
I'm a big fan of Marc Chaikin, though, so it makes me nervous, Scott, because I like his metrics of looking at the market.
Marc Chaikin.
Marc Chaikin.
An expert known on Wall Street for developing computerized stock selection models.
Joining us is Marc Chaikin. He is the founder of Chaikin Stock Research. Mr. Chaikin, welcome.
All right, good afternoon, everyone. This is Joe Bocelli here at Chaikin Analytics, and I'd like to welcome you to our presentation of Discover the Best Option Strategies for 2017. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics, along with Tony Zhang, co-founder of OptionsPlay. Now, as a reminder, this webinar is being recorded, and we'll have a copy of the recording sent to everyone who has registered. Please submit your questions throughout the webinar using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. Now, Marc and Tony are here to tell us about how you can profit in 2017 using the best option strategies by using the Chaikin Analytics and OptionsPlay platforms. To get us started, here's Marc Chaikin. Marc, I think you're still muted.
Thank you, Joe, and welcome everybody.
Take it away.
This is our first webinar of 2017, and I'm happy to welcome everybody, particularly our good friend Tony Zhang from OptionsPlay. As you can see, we've sort of backdated the webinar deck, and we're looking at Tuesday, January 10th, 2016. So the PowerPoint gremlins have attacked us yet again in 2017. But in today's webinar, we're going to look at a plan for 2017 and how you can incorporate options into that plan. So a little bit on my background: 50 years on Wall Street, lived through 10 bear markets. Early on, I realized that you had to use technical analysis in conjunction with fundamentals, which drive the market, in order to protect capital during bear markets and really zero in on the winners, because technical analysis tells you what's happening in the market and the fundamentals tell you where the potential is. So along the way, I've been mentored by some of the smartest and most successful institutional investors. Some were colleagues and some were clients. And the reason that's relevant is that I learned the way they made investment decisions. And everything I learned, I used in creating the Chaikin Power Gauge rating, our 20-factor, fundamentally driven model that for 5.5 years, now 6 years actually, has done an extraordinary job of finding the stocks that are going to outperform the market and also identifying those stocks, as we'll see later on in the presentation, that are likely to implode and underperform, but more importantly, create havoc with your portfolio and with your psyche. And all of this is the culmination of my life's work. It was my unfulfilled dream to be able to give investors, from the trading point of view all the way up to people who are investing for their retirement, the tools that they needed to be independent of financial advisors and Wall Street gurus. Now, we've been fortunate to be quoted in the media and to have some of the most successful investors on Wall Street using our Chaikin Analytics product and the Chaikin Power Gauge rating. People like Paulson Hedge Fund and the Soros Hedge Fund and Fidelity Investments, and also some of the most highly regarded analysts and traders on Wall Street. John Carter of Simpler Trading, John Malden of Malden Economics, Tom Gentile from Money Calendar, using and endorsing the Chaikin Power Gauge rating. And we're going to show you in the presentation why the Chaikin Power Gauge rating is so important to any strategy, from options and swing trading all the way up to managing your 401k plan. Now, with us today, as Joe said, is Tony Zhang. We integrated OptionsPlay, which Tony co-founded, into Chaikin Analytics because there was so much demand from our user base for options ideas that were generated in the same methodical, probability-based way that the Chaikin Power Gauge identifies the attractiveness of a stock or its potential to underperform. So, Tony, why don't you just step in and tell people a little bit about your background and about the experiences that we've had partnering with OptionsPlay.
Thanks, Mark. Thanks, everyone, for joining this afternoon. My name is Tony Zhang. I'm head of product strategy here for OptionsPlay. A little background about myself. I spent 7 years at a company called Gain Capital. Some of you may know that as Forex.com, for those of you who trade Forex. I spent 7 years there as a market strategist, helping people navigate the currency markets. I actually helped them start up their securities business, and that's how I got into the options business. And about 4 years ago, we started OptionsPlay with the intentions of helping your average investor better understand options. And the reason for this was because we looked at the tools that are currently out there offered to your average investor. And we realized that they were a bit too complicated. If you had a directional view on a specific stock, or if you wanted to trade a cover call, and we looked at how users were selecting their expiration dates and their strike prices and their strategies, and we realized that most investors didn't really have a method or a strategy to going so. So a lot of times it was just guessing which strike prices to choose, which expirations to do. So what we did is we set out to create a platform that will help and guide the average investor in how to find the appropriate option strategy, regardless of what your views are, whether you're bullish or bearish on a particular stock, or you're looking for income strategies for your existing portfolio. And that's what we're going to show you today. And most importantly, we're going to show you the combination of the two, the power of the Chaikin Analytics platform and helping you select your stocks and your direction, and then leveraging that into OptionsPlay to show you how you can quickly identify option strategies that will take advantage of those views on that underlying stock. And what we really hope that you guys walk away with today after this webinar is having the confidence to be able to do it yourself. And we're going to show you some real life examples today that Mark and I will be going over, whether it's bullish or bearish views on a specific stock, or hedging against, a portfolio that you currently have. That's what we're going to go through some live examples today for you guys.
And Tony, although Chaikin Analytics was an early adopter of OptionsPlay, there are a number of very significant firms who have licensed and are offering OptionsPlay to their clients. Could you just sort of share the top level view of a few of those names?
Yeah, absolutely. So for the retail brokers, or the those of you who are trading your own retail accounts, OptionsPlay is now integrated into firms like Merrill Lynch and Options House, SoGo Trade, First Trade. And for those of you who are financial advisors, we are now sitting in all of Raymond James's financial advisors suite of tools. We are now in the process of signing up a couple of other quite large financial advisory firms that we're in the process of going through. So this is a tool that's actually quite widely used across the industry for both individual investors and financial advisors currently.
And thank you, Tony. And as you'll see, it really is state of the art. We could have made the decision to build this ourselves. We have a great development team and user interface people. But when I saw OptionsPlay, particularly with my background, having run an options department for 5 years, I decided that it would be better to get this integrated more quickly into Chaikin Analytics rather than spend a year building it and maybe not even coming up with as good a product as they've created. So in today's webinar, you're going to see how to profit from smarter option strategies. And first, we're going to look at the Chaikin Power Gauge rating and our proprietary relative strength indicator to see how it helps you find bullish and bearish candidates. I'm going to show you how to use Chaikin Money Flow, which, as many of you know, has been available since 1982. It's on all the major online brokerage platforms, as well as TheStreet.com, plus Bloomberg and Reuters. But we're going to show you a very special way to use Chaikin Money Flow to anticipate future price movements and share with you some secrets that we've been teaching Wall Street pros for years on how to use Chaikin Money Flow. along the way, you'll see that we have 6 pairs of buy and sell signals in Chaikin Analytics, which help you improve your timing, which is obviously critical to options trading. Also going to show you the inner workings of OptionsPlay, so you'll be able to quickly and easily find the best option strategies and know that OptionsPlay is your friend in terms of trying to accomplish that. And we're going to show you our earnings alerts capability, and we'll reference how to use options to supercharge your profits during earnings season. Now, earnings season began yesterday. It gained some momentum on Friday when the major banks start to report, but we are doing a webinar next Monday on Martin Luther King Day at 1 o'clock where we're really going to dive into earnings season. Today's webinar is more about 2017 and specific option strategies that you can use right now. So I'd like you to ask yourself a question. Do you have a plan for 2017? Do you know where to look for profits in 2017? If you do, type in a big P in the chat box. And I see that a number of you have a plan, but it's not across the board 100%. And I've got to tell you, it's absolutely critical, particularly with a new era in Washington, to have a plan. So we're going to spend the first 10 minutes or so of the webinar looking at 2017 in terms of the various alternative investments that you could be making and where your money should be allocated based on historical trends. So it's logical to start looking at the Treasury market, which has been in a bull market for 30 years. And on the screen, we have a 1-year chart of the TLT, which is the 20-year Treasury ETF, very actively traded. And although a lot of people think that the bond market broke down after the Trump victory and the Fed raising rates in mid-December, it actually, as you can see on this chart, peaked back in late June and was trending down well before the election with a lot of Chaikin money flow, which is this red-green oscillator here, being negative, indicating that people who own the TLT and benefited from the huge drop in interest rates and the rise in bond prices all through 2015 and 16 were exiting the party. Now, you've had a retracement rally, and it's pretty feeble in terms of that big drop from 144 all the way down to 117. It's barely breathing in terms of a rally, and we've already gotten overbought. So bonds are not the place to be in 2017, and we're going to show you why. So if bonds aren't the place to be, then we've got to look toward the stock market. And if you're funding your retirement, obviously you need stocks and equity exposure in order to beat inflation and to grow your assets. So we've got a number of choices in the market. We use ETFs to sort of categorize what the various market segments are doing. So here we're looking at the SPDR, the S&P 500 ETF, which is the most actively traded instrument in the US markets. And we're in a very well-defined trend channel. So trend lines connecting the highs and the lows turned the market back here in December at the 2275 level on the S&P 500. And that trend line is now at 2300, which coincides, by the way, with our upper volatility band. Now, looking back to the beginning of 2016, we see that the market made a double bottom, and Chaikin money flow is actually very positive as we made that second low in the 1809 area on the S&P. That was a good sign. It meant that the institutions were actually buying the weakness, and that money flow stayed strong all the way through September of 2016 when we started a decline that ended with the surprise victory of Donald Trump in the November presidential election. And finally, the money flow reflected a little bit of negativity in the market running into the election. So it turned negative, which is not unusual, but then it picked up again as we went to this peak at 2275. And until we make a new high at that upper trend line, we're not going to call this bearish, but money flow is nowhere near where it was, particularly in the large cap segment of the market, which is represented by the spider. Now, the picture for the small cap stocks, which incorporate value and growth, this is quite different. This is the IWM, the Russell 2000 small cap ETF. And I know many of you use ETFs to make market bets and also to allocate toward individual sectors. So if this is relevant for you, type a big R into the chat box, please, and we'll sort of point our presentation toward the ETF opportunities if that's where you are coming from. And I see many of you trade the market ETFs like Spider and IWM. Thank you, Mike. Thank you, John. I see that you've used Chaikin to do that as well. So we've got some subscribers on today. But basically, starting in May of 2016, small caps reversed about a 15-month trend relative to large caps. They started to outperform. That's our relative strength indicator here, which is a red-green heat map. We make it really easy for you to know what particular tradable like the Russell 2000 is doing relative to the S&P 500. But here again, we see that money came out ahead of the election, but it's also been coming out of the market as there's been a lot of rotation going on, a lot of profit taking in small caps, which had huge run-ups, particularly in the financial sector after the November presidential election, also in some of the industrial stocks that would benefit from renewed infrastructure build in the Trump administration, and also deregulations or a sort of rollback in regulations that small cap and financial stocks particularly found very onerous over the last 4 years. But the bottom line is we can't draw that nice trend line on the Russell 2000 because we broke out in November. And after a consolidation here, the Russell 2000 was actually the best performing segment in the market today, up 1%, with the S&P flat and the Dow Jones down. So NASDAQ and Russell 2000 benefiting from group and sector rotation. Now, what should your focus be in 2017 post-election? Well, 4 things are of major importance: the trend of corporate earnings, where interest rates are headed, sector and group strength and weakness, and volatility, because volatility is going to be with us all through 2017, especially with this new regime in Washington where the Republicans control both houses of Congress and the White House. Now, what's the likely scenario for 2017? This is really critical to developing a plan, whether you use options or whether you're trading primarily in equities. It's very important to know what kind of climate we're in so that you can be focused on the right segments of the market and the right sectors. So let's just look back a bit. This is a chart courtesy of Bank of America, Merrill Lynch. And after the financial collapse of 2008, we were in the most bullish scenario from 2009 through 2014. Falling interest rates as the Fed was trying to stimulate the economy with quantitative easing. Interest rates dropped to 0. They actually went negative in Europe, as many of you know, and rising earnings because the comparisons to 2008 when earnings fell through the floor were favorable, and they continued to be favorable in a slow growth, what I call a Goldilocks economy, not too hot, not too cold, GDP growth of 2 to 2.5%. In 2015, we entered into a much less favorable environment, one with falling interest rates, continuing the pattern, but falling earnings. And those falling earnings were primarily in the energy sector, but also in other small cap stocks. And that ended in the third quarter of 2016. So we've now segued to the upper right quadrant here. And in 2016 and in 2017 going forward, we're anticipating higher interest rates and rising earnings. So in the third quarter, which was announced beginning in October of 16, we broke a trend of 6 quarters in a row of year-over-year earnings declines. It was known as an earnings recession. And it caused a lot of analysts on CNBC to predict a bear market. And I think most of you know that bear market never happened, and we're going to address pullbacks in a moment. But the bottom line is, third quarter of 2016 broke that trend. Year-over-year earnings were higher, and we expect the same to happen in the fourth quarter. Those earnings are being reported as we speak, and then going forward, the expectation in the marketplace is that the Trump agenda of rollback in regulations, rebuilding the infrastructure in the military, and cutting taxes should be a stimulus to earnings. So we're in a bullish phase of higher rates and rising earnings. Don't be afraid of higher rates. If you get people on CNBC telling you that higher rates are bearish for the stock market, don't believe them, because this is only the second rate hike in the cycle. And the reason it's bullish is because the Fed was comfortable raising rates because the economy is gaining strength week by week. Jobless rate has dropped. We're creating new jobs and wages are rising. So we're in a bullish environment, and gradually rising interest rates are positive. So what is the impact of the Fed's decision to raise rates for a second time in the cycle back in December of 16, and their sort of projection of 3 rate hikes in 2017? And be mindful that projections are just that, they don't always materialize. Well, my colleague John Schlitz prepared this chart. I want you to focus on the periods that are shaded green. This chart goes back over 30 years. And what we're doing, it's actually 40 years. We're looking at what the market did when interest rates were rising. And as you can see, almost every one of these green columns shows you that when interest rates are rising, the stock market, as measured by the S&P 500, was also rising. So here we are again in 2017. We're in a period of rising rates, and the stock market is making new highs. We had the NASDAQ make a new high today. The S&P made a new high last week. So stocks rally during periods of rising interest rates, but not every sector goes up. So here we have a chart which I think is absolutely critical to making money in 2017 and developing a plan that helps you focus in the right place. So this graph shows you which stocks do well in periods of rising interest rates. They're circled in green. These sectors, financials, industrials, technology, energy, and materials do well historically in periods of rising interest rates. And the defensive stocks, which typically have higher yields, like utilities, telecom, consumer staples, and healthcare, typically underperform the market in periods of rising interest rates. The outlier is consumer discretionary, which is interesting because the consumer discretionary sector is all over the place. It includes home building, it includes retailers, it includes Amazon, a whole host of stocks that are sort of linked together and called consumer discretionary, and they fall outside the normal bounds. Now, what's going on in the market right now is group rotation. As you'll see in a minute, over the last 3 months, since the election, and even 3 or 4 weeks before, if you rank the 10 select spider sector ETFs, the large cap S&P 500 carved up into 10 different sectors by price performance, it almost exactly matches the chart we just looked at. Financials have led the way with a whopping 20% gain over the last 3 months. Industrials and materials up over 9%. Energy. The only outlier so far is technology, which is still up 4%, but there have been a lot of cross currents in technology. And there's that consumer discretionary outlier, just as we would have expected. And then look at the bottom. The real world is mirroring what we was led to believe by looking back over 40 years. The weak performers are interest rate sensitive stocks, consumer staples, real estate, utilities, and healthcare. Now, healthcare benefited from some group rotation today. Healthcare stocks led the NASDAQ to new highs. So you're going to see these cross currents, but stay focused on your goal, which is to find winning stocks in the sectors that do well in a rising interest rate environment. Now, the fourth factor we said was important in 2017 relates to volatility, and it's important to know that volatility is not a recent phenomenon. Every year, markets experience corrections. Over the last 30 years, the annual correction has averaged 14%. That's a tiny bit misleading because you've got some big bear markets in there. But those who stayed the course were rewarded. Now, if you're a trader, you're obviously going with the shorter term trends. But if you're investing in your 401k plan, if you're trying to grow your retirement account, it's important to know that pullbacks happen all the time. Over the last 70 years, we've had declines of 5 to 10%, 75 times, averaging more than one a year. Now, what's interesting is they typically last only a month, and then within a month, assuming that they were limited to less than 10%, they recover back to new highs. There have been 11 bear markets since 1945. Bear market is defined as an index dropping 20% or more. So 11 in 70 years, about one every 6.5 years. So when you see people on CNBC calling for a bear market, or if you're constantly looking over your shoulder, as some of my friends are wont to do, looking for shadows and bubbles, you're going to miss out on some enormous opportunities. Again, if you're a trader, you're looking for the shorter term patterns. If you're an investor, or even a swing trader, be aware that corrections are your friend. Those 5 to 10% corrections are actually opportunities, and now we're going to show you some of the tools that you can use to take advantage of those opportunities. But before we do that, I've put up a graph from OptionsPlay, and I'm going to let Tony sort of explain what you're looking at. The purpose here is if you think there's going to be a decline after the inauguration, maybe a little bit of profit taking as Trump gets into the real task of governing and working with Congress, there's a way you can protect your portfolio. And in this case, we're protecting a 4% drop in the S&P, or roughly a 5% drop. So Tony, why don't you explain very briefly what we're looking at here is a good way to segue into what OptionsPlay can do for our Chaikin community.
Yeah, sure. So what you're seeing on your screen here is the OptionsPlay widget. Hey, Mark, do you want me to share my screen?
Not on this one, Tony, because I think this really covers it, but then we'll get deep into it on the next example.
Okay, so what you're seeing is the OptionsPlay widget, which you can pop out for any symbol directly from the Chaikin Analytics platform, which we'll show you in a second. And for any strategy or any symbol you type in, you're going to be presented with 3 strategies. In this particular case here, we're looking at bearish strategies on the S&P 500. This is a great way that you can use to potentially hedge against the short-term correction on the markets while still staying in your portfolios. And as you can see on your screen, you're displayed 3 different ways to go about taking advantage of a bearish view on the S&P 500. And these 3 strategies will cover the 3 most popular trading strategies by individual investors and financial advisors to take advantage of a bearish move. So you always have trading the stock on the left. We have buying a simple call option or a put option here in the middle, and then we have a put spread or a put vertical here on the right. And this is designed to allow users of any type of sophistication in options, whether you're new to options or you've been trading options for years, to be presented with a starting point without ever having to pull up an option chain to first select an expiration or a strike. Because a lot of times, if you're just looking to hedge the S&P 500, you may not have a specific date in mind or a specific price movement in mind. This is designed to help provide some starting points for you so that you can start playing around with it and putting these 3 on a level playing field so that you can start comparing different strategies. And we'll show you using the actual widget on the platform in a few moments.
Yeah, what I like about OptionsPlay, and thank you, Tony, for that, is that it uses probabilities, implied volatility, and normal price distributions to grade the various alternatives. So most people, if they were going to protect a portfolio, would buy a put option on the S&P 500. As you notice, that's only circled in yellow with a 96 score, but the vertical put spread, buying the 227 put with the S&P at 226.34, so it's slightly in the money, and selling the 218 put against it, recouping some of your cost, actually is the cheapest strategy with the best risk-reward ratio. So for $227, you can hedge $22,600 worth of the market. So if you had a $25,000 portfolio, putting on one of these put spreads would protect you on a roughly 4.5% decline in the market. And what's interesting is that's your total risk, $227, and your profit potential is down here. It's almost a 300% profit potential in this spread if the S&P 500 drops to 218 by February 24th, which is the expiration. So it just shows you how easy it is to protect yourself and enjoy the upside potential if the market continues higher. Now, I think you can sense that there's a problem that we all encounter in our investing and our personal lives as well, which is information overload. Part of the reason I came out of retirement to start Chaikin Analytics is that I felt that people were, after the financial collapse of '08, taking back control of their financial future, but they needed the tools to do that. And the reason is there's so much information to digest if you're going to make investment or trading decisions. So the key to making money, in my view, is how to focus in the age of distraction. That's right at the center of this chart. And I really like this chart. Joe Bicella, who's our webinar organizer and in charge of our customer success team, told me that one of our clients told him that he printed this chart out and put it on his bulletin board because it really is the key to making money. And we started out with the sector analysis because that's an example of focusing on the most likely place to make money or the places where you might lose money in 2017. Now, our solution to the information overload problem is Chaikin Analytics for iPad and desktop. Now, we're going to show you examples of the Chaikin method and the Chaikin intellectual property as we move through the presentation. Now, as you'll see in just a moment, we've integrated OptionsPlay into Chaikin Analytics. It helps auto-generate strategies and ideas, as you've seen. There are 4 interactive panels, and Tony will give you an example of that in a moment. And it enables you to set your own parameters so that you can find strategies that match your own particular risk tolerance and objectives. So summing it up, Chaikin Analytics leads to consistent option profits by giving you a directional edge. Now, I ran an options department for a regional brokerage firm for 5 years. There were about 250 brokers at Tucker Anthony, thousands and thousands of options traders, and I can tell you that 95% of those options traders lost money. And the reason, in my opinion, was they didn't understand the importance of a directional edge. It seems so obvious and simple. They were making wild bets in out-of-the-money call options with short-term expiration dates, trying to turn a very small amount of money into a big pot of gold. And that's a worthy ideal. And there are times, especially during earnings season, when you can do that. But if you do it all the time, you're going to lose, and I saw that happen. So what Chaikin Analytics does is to give you a directional edge by combining fundamentals with technicals into a quantitative model and then providing you with some buy and sell signals to better time your exits and entries. So I want to spend a little time on the power gauge because part of what we're trying to accomplish in this webinar is to convince you that a disciplined methodology should be part of your plan for 2017, whether it's based on Chaikin or Investors Business Daily or any service that you feel is valuable. Disciplined methodology is absolutely critical in volatile markets. So we start on the top with the Chaikin Power Gauge rating, which is our core intellectual property because it's better than anything else on the market, and you'll see why in a minute. And then we also look at sector and industry group rankings, and I think you can see the value of that and appreciate it from the slide we put up earlier. At the bottom of this pyramid, 2 technical indicators. You don't need 22. 2 are enough. Chaikin money flow to measure what the institutions are doing, and Chaikin relative strength to determine whether a given stock is outperforming or underperforming the market. And then in the middle, those 6 pairs of buy and sell signals. Now, the Chaikin power gauge is displayed in a very simple way. It's a gauge that looks very much like the gas gauge on your car. And I like that analogy because even though this looks simple, it's very powerful. And I like to say on these webinars that the Chaikin power gauge is like a Chevrolet with a Ferrari engine under the hood. And one of our partners, John Carter, the CEO of Simpler Trading, probably one of the best traders, pure traders I've ever known, backed up by real-time performance every day, has taken a shine to the power gauge rating, become a partner of Chaikin, and he called it an objective awesome meter for stocks, saying there's a lot of hyped up tools, but when I find something interesting, I'll let you know about it. So you can imagine that a single tool that combines 20 plus technical and fundamental factors to anticipate a stock's profit potential got my attention. Now, let's see what John Carter was looking at when he came to that conclusion. Chaikin power gauge is comprised of 20 factors grouped into 4 components. And it's what I call an eclectic quantitative model. What that means is it's not a value model, it's not a growth model, it's not a earnings momentum model. It combines the best of all of those. And the reason the power gauge works and why it's worked well for our clients for 6 years now is because it reflects the way Wall Street works. This is what I learned from the mentors that I've had along the way who shared with me the way they make investment decisions. These are the indicators that Wall Street professionals use every day to make their buy and sell decisions. Now, not all institutional investors or hedge funds or traders use all 20 of these, but value investors look at the financial metrics, someone like a Warren Buffett, some of the quantitatively driven portfolios that are being created, also something that we're getting into at Chaikin. Look at free cash flow and price to sales ratios. Jim Cramer zeroes in on earnings. When he was running a hedge fund, that was his go-to set of metrics. The technicals are only 15% of the model. This model is 85% fundamental. And that's important because it does the fundamental work for you. How in the world, with all the other pulls and tugs on your time, could you possibly analyze stocks 5,000 strong in the US markets, even if you know what to look at? You have to have the time to do it and know how to weight the various factors. And then, of course, our secret sauce, expert opinions, short interest, insider activity of the insiders buying their own stock. And in today's webinar, we're going to focus on industry group and sector relative strength. So a little bit about the performance of the model. This is the lifetime performance. The average very bullish stock in the Russell 3000 up almost 20% a year, and the average very bearish stock down 1%, and that's after a 7-year bull market. But let's drill down a bit. First at 2015 and then at 16. 2015, if you were in the very bearish stocks in the Chaikin power gauge rating, you lost on average 17% of your money because there was a bear market in small caps, there was a bear market in energy stocks, the fracking stocks, the offshore drilling stocks, even the major oil stocks. The rails were very weak because we weren't moving product around from the energy complex. Very bullish stocks down only 1%. But now go to 2016, a year when the market was up 10%, and the very bullish stocks were up 32%. Versus the very bearish stocks up only 9%. And this with the Russell up 15 and the average stock in the Russell up 24. Why the difference? Because the S&P 500 and the Russell 3000 are what's known as capitalization weighted index. The largest stocks in the index have an outsized effect. So look at that spread between 32% if you focus on very bullish stocks, 29% on the bulls, and only 9% on the very bearish stocks. So the message here is avoid the very bearish stocks, use them for put candidates, and focus on the very bullish stocks. So we're going to get Tony involved in a minute. Want to show you two patterns to begin. Classic Chaikin bull helps you identify what to buy and what to have on your radar screen if you're looking for swing trading candidates to the upside and call option candidates. Very simple three-part methodology. Chaikin power gauge rating is bullish. The stock is outperforming the market, and Chaikin money flow is strong, letting you know that the institutions are accumulating the stock. Now, even though healthcare has been underperforming heading into the election and then afterwards, WellCare Health, WCG, on this one-year chart has been making new highs, as has United Health, which we could have just as easily used. Now, at the bottom of this one-year chart of WellCare, we see the power gauge rating output as a ribbon that normally fluctuates from red to yellow to green, but because this stock has had bullish fundamentals since February of 2016, the power gauge rating has been almost universally green or bullish. Right above that, the relative strength of WellCare to the S&P 500 started outperforming in March when the stock was at about 100, 98 to 100 on the way to 140. And we say that when the relative strength and the model agree, the market agrees with the model. We have a new arrival here at Chaikin Analytics, who's going to be running our asset management business, and he comes from Zweig Advisory, and Marty Zweig was a good friend of mine. And Marty used to say, watch the Fed and listen to the market, because when the market tells you everything. So no matter how good your fundamental model is, if the market disagrees with you, that's at worst dead money, and or worse, at best dead money, and or at worst it's really a disaster in the making. So here we have all the ingredients of the Chaikin methodology. Money flow here was extremely strong through this big accumulation up phase. We have our buy signals, money flow buy in this case, and then we also have an earnings module that we referred to earlier on, that we'll show you that in a little more granularity. But basically we tell you whether a company has been reporting better than expected or worse than expected earnings, and we convert that into an earnings alert indicator here at the upper of the screen. We show you when the next earnings date is, which is very important to options traders, and we also tell you whether our earnings alert indicator is bullish or bearish. A bullish indicator means the stock is likely to report a positive earnings surprise. So when we look at classic bears, we're going to bring Tony in a minute. Turn that on its head. Power gauge rating is bearish, stock is underperforming the market, and Chaikin money flow is red, not green, telling you that institutions are selling the stock. Now here's poor Chipotle, which had a very nice 4% rally today as the company had one of the first positive statements about the future in a long time. Our power gauge rating turned bearish off the charts. That's why I put that red circle up there on the left at about 690 on the way to 360. And along the way, the power gauge rating has stayed bearish. It's been underperforming the market, and Chaikin money flow has indicated that the institutions continue to sell the stock. So with the stock having gotten overbought today, and our overbought indicator will show that tomorrow, I put up a screen from OptionsPlay. And Tony, if you want to share your screen now and run through this and anything else you'd like to show the folks to illustrate how you can implement a bearish strategy in Chipotle. Now, we've been recommending these going back to April, so this trade may be long in the tooth, but it's a good example if you're still bearish on Chipotle and think this rally is a flash in the pan of how you can implement a bearish strategy that makes sense from a probability point of view. So Tony, why don't you share your screen and feel free to delve anywhere you like into OptionsPlay.
Sure, thanks, Mark. So if everyone can see my screen, I'm just going to show real quick how to launch OptionsPlay. So we've seen the Chaikin Analytics screen. So as you can see on the top here on the navigation bar, there's a button called Options. Once you click that for any symbol, what will bring up is this widget that we've shown you before that will bring up 3 option ideas for that symbol, whether you're bullish, whether you're bearish, or like I said before, if you're looking for income strategies such as cover calls and short puts, OptionsPlay will actually instantly try to find you the 3 strategies for any directional view. So today, I think starting off basically because we started off talking about the market, I'd like to just show everyone a little bit about how we can use this tool to find some hedging ideas for the overall market. And this could be useful for those of you who are long the market, who feel that the market's maybe a little overextended, but it's not time. You don't want to get out of it because this market could easily continue to rally higher. So you might want to look for some cheap ways to buy some protection. And being volatility at all-time lows, protection is actually very, very cheap. So what I wanted to do is show everyone how they can use this tool to go about doing so. So like I said before, when you click on I'm bearish here on the very top, it'll always present you 3 bearish strategies. Now, even if we don't want to modify these any further, this is a good starting point for everyone who wants to perhaps find some hedging ideas. And you can do this on the S&P 500 if, let's say, you have a relatively diversified portfolio, or if you're concentrated in some sectors like financials, which has been extremely overbought for quite a few weeks now, and maybe you want to buy some protection, you can do this on XLF or any other sector that you may have a heavier exposure in. So once you pull up these 3 strategies, like Mark said before, the first thing you're going to notice is the OptionsPlay score. As you can see, you can either short S&P 500, which is probably not a recommended strategy to go about doing so, but you can buy this put strategy for $345, or you can buy a put spread, which significantly reduces the cost or your risk of providing a hedge from $345 down to $228. Now, most trading platforms will provide you a breakdown that looks something like this, that will tell you what the cost of the trade is, the max reward, max risk, probability of profit for some of the more advanced trading platforms, break-even numbers, and days to expiration. Now, these are all numbers that are very important when trying to decide which strategy is suited for you. However, we found that these numbers are actually quite difficult to compare because buying a put gives you a max reward of $22,000 if the stock goes down to 0 in the next 45 days, which is quite unlikely to happen. So how do you compare that with a strategy that only gives you a max reward of $672? And that's really why we set out to create the OptionsPlay score, so that we can better view the realistic probabilities of what's going to happen with the S&P 500, weight them by the expected losses or gains of each strategy, and give you an idea of a true risk reward as opposed to what could potentially happen if the stock goes to 0, or what could potentially happen if the S&P 500 shoots up to 400, overnight. So, which are unrealistic expectations. So what we've created is a P&L simulator, and I wanted to give everyone a few different ideas that you can walk away with today to consider for hedging purposes. And what I'm going to do is I'm going to replace selling 100 shares of the S&P 500, which I'm guessing most of you won't go doing, and replace it with a out of the money put spread. So as you can see, I can create any strategy here. I'm comparing the February 24th 227 put, which is the at the money put, versus this put spread that's already optimized for you. And then what I'm going to do is I'm going to look at what happens if, let's say, I buy an out of the money put. Let's say I buy a 222 put. And what the P&L simulator really allows me to do is simulate the different scenarios that could play out on the S&P 500 and see what am I going to expect for each one of these 3 strategies. And I think there's really 2 scenarios that we need to consider. When we look at the S&P 500, generally speaking, as we were talking before, sometimes we see very quick corrections that come roaring back a few weeks later, and then sometimes we see really slow corrections lower, as we can see here from between September into the November election. We just had a really slow grind lower versus back here in late June and July, we had a really quick sell-off and then a really quick recovery. So those are the two general scenarios that we're considering when we're looking at corrections. And the P&L simulator really allows you to look at both scenarios and quickly see which strategy gives me the best protection in different scenarios. So the first scenario I'm going to give is what happens if we get a slow grind lower into inauguration, and after inauguration we continue get a slow grind lower. Let's just say we think this S&P 500 may correct down to 215 by expiration. And as you can see, I clearly see that these three strategies, each of them give me a nice return, but the strategy here on the right gives me the highest return, a 294% return. And for those of you who expect a shorter term move, meaning you expect the S&P 500 to correct very lower very quickly, maybe you expect that move to happen in a very short period of time. Maybe you expect it to happen right after inauguration. So in this particular case, as you can see, buying an out of the money put gives me the highest return, 307% return, versus perhaps somewhere in the middle, it's still going to show me that this out of the money put will give me the best return if I'm expecting a short move or a quick move lower. So you can use this P&L simulator to create all different types of scenarios, whether you're bullish on a stock, bearish on a stock, or you can say, what happens if I'm completely wrong? How much am I going to lose on each one of these three strategies? And really see for yourself which strategy is best suited for you. And this tool is really designed to help you guys play around with the different scenarios, play around with the different strategies, and see for yourself. And for those of you who are a bit more sophisticated with options trading, you might even select different volatility assumptions for if the market was to move lower, which strategy gives you the highest return. This tool is designed to give you that flexibility without having to overwhelm you with lots of numbers and having you pick different strategies first before you're able to see any of these analytics. So with that, I'll just jump real quick into Chipotle, which is a stock that we've looked at many times on these webinars. Over the last year, we've actually picked quite a few Chipotle trades. As you see today, we've had a huge run up in Chipotle today based on some news. But if, let's say, you're still bearish, you think this news is a short-term correction, you think the stock's going to continue heading lower, clicking on Chipotle again, you're presented with the same three strategies, and you can use the P&L simulator to simulate where you think the stock's going to head to. If you're bearish, I think this 200-day moving average is a pretty conservative target around 365. And if the stock really moves that way, you're going to expect about a 200% return by trading this put spread, versus just buying a put, you'll get about 148% return, which is still quite high, versus only shorting the stock, you'd only get about a 12% return. So this is really where the combination of the power gauge rating, giving you that directional edge, combined with the options play, will really allow you to get some explosive returns, because if you're right, you're seeing some very, very large returns. And the best part about trading these options when you have these directional bets is that if you're completely wrong, your losses are limited to what you've paid for this option. So you can define how much money you're willing to risk, so that if you're completely wrong, you know exactly what you're risking. And then if you're right, you can make some very nice outsized returns by trading these put spreads, which really limit the amount of risk that you can take while still giving you that upside in either direction.
Well, thank you, Tony. I know we're going to look into some option writing strategies to generate income, covered calls, particularly on stocks you may own that have had big run-ups. So we'll look forward to that in a couple of minutes. Let me take the screen back and this is where I always run into trouble, Joe. Let me get back to the presentation. Okay, so let's look at two other concepts, and then we'll get into some sector analysis and some specific options ideas. We combine fundamentals with technicals, as I said. Chaikin power gauge rating and Chaikin relative strength is a combination that we call the dynamic duo because it helps you find big winners and losers. So here's an example of that. And it also incorporates the concept of a personality change. When a stock goes from underperforming to outperforming the market, as the small caps did back in the spring of 2016, we call that a personality change. And here we're looking at a one-year chart of Quanta Services, symbol PWR, and they provide equipment for the power generation industry. And obviously, if there's going to be infrastructure build in America, more power plants building and so forth, companies like Quanta will benefit in the construction and building services area. And the stock had a very, very strong run up. It also illustrates a concept that we call stealth accumulation, and that relates to the Chaikin money flow and what it does when stocks are going sideways to down. Instead of going negative as we would expect, the money flow on Quanta stayed green or bullish all through these accumulation phases, and then finally it exploded up to new highs after the election. Because the stock from a valuation point of view got overextended, remember value metrics are key to the model, 35%. The power gauge rating has now turned neutral, but it's a perfect example of the dynamic duo and our money flow pattern that we call stealth accumulation. Now on the downside, we've got Coca-Cola, very well-known name worldwide, but we had a bearish personality change in April, and then in May, the power gauge turned bearish, so the dynamic duo was now negative on the downside. The market was agreeing with the model, but in a bad way if you were long the stock. And Chaikin money flow showed that institutions were selling the stock between July and the election. You had a period of distribution, and this has been dead money, as we referred to earlier. So the power gauge turned bearish in May. How many months ago is that? Well, that's about 9 months ago. Look what happened yesterday. Goldman Sachs downgrades Coke and Procter & Gamble to sell. Well, where were they 9 months ago? That's why the power gauge is so important to making money and being independent of Wall Street gurus, reading barons, where things tend to get recommended late in the game. Here's a major brokerage firm with a huge commitment to research, some of the best analysts on Wall Street, and they're just now turning bearish on Coca-Cola when the power gauge turned bearish at a price of about 45, 10% above where it's trading right now. So it shows you how you can become independent of Wall Street. Now, a dramatic example of that is this chart of SunEdison, which was a darling of the solar energy business, where the power gauge turned bearish back in June of 2015. This chart ends in April of 2016. The reason it does is the company filed for bankruptcy. Along the way, the power gauge turned bearish. Now, Coca-Cola is not going bankrupt, but it's a very similar pattern, just more volatile stock here in SunEdison. And then the stock started underperforming the market in July of 15. That's the dynamic duo. Money flow was weak. The institutions were bailing out on this former favorite. Merrill Lynch actually had a buy recommendation on the stock up there at 28.30. And they did put out a sell recommendation, but it came in February of 2016 at $3. And you can see on the screen that SunEdison in April filed for bankruptcy. Now, we got this testimonial from an advisor at Merrill Lynch who saw this chart in a booth that we had at an options conference out in California for advisors last May. And he gave us this testimonial. He said, I bought SunEdison at 15 on the way down, which my firm Merrill Lynch was still recommending. If I'd been using Chaikin, I would have saved a lot of pain and money for both myself and my clients, because Edward M. bought the stock for himself as well. Shows you how unbiased, disciplined methodology can keep you out of trouble. It's going to work out every time? Absolutely not. But if you want to put the odds in your favor in the same way that OptionsPlay puts your options odds in your favor, follow the power gauge rating. Now, one final pattern, we call it stealth accumulation and distribution. You saw an example of it with Quanta. Here's the pattern that we've been teaching Wall Street pros for years. This is a one-year chart of Qualcomm. It had been out of favor. It started outperforming the market back in May when the stock was 50 on the way to 70. And money started coming into it because the institutions started looking favorably on the stock again. And you were having that pattern of stealth accumulation. As the stock was going sideways to down for 2 months after a spike up on a positive earnings surprise, money flow stayed positive. What did that mean? It meant the institutions were buying the dips. And for each subsequent peak in the stock, money flow was green and peaking until you made that final high in October. And look what happened with the stock at the upper volatility band, new 52-week high, money flow was negative. Institutions were taking profits as the stock was spiking up to a new high. This is a pattern that's worked for over 35 years. We've taught it to Wall Street traders, hedge funds for years. It's one of the only tools I know that will enable you to sell a stock with confidence at an all-time high and feel that you're not leaving too much on the table. You always risk leaving something on the table when you sell a stock. And notice what Qualcomm has done since then. Nothing. Even though tech stocks, as we'll see, have actually moved up to new highs. So if you were fortunate enough to sell that, even though the power gauge was still bullish, that money flow sell alert, we call it a money flow divergence at a new high, is a very powerful tool. Now let's head into what I consider the important part of this, because we're in a climate of rising interest rates and it's important to follow the sector strength as we saw earlier. So group and sector strength are very critical. Strong sectors based on the power gauge rating give you a tailwind, and that equates to bigger profits on the long side. And weak sectors, if you go long, create headwinds which are better suited to short profits than trying to make money on the long side in a weak stock or industry group. So one thing we do is to focus on the 10 select SPDR sector ETFs. And we rank them in a very different way than anyone else. We don't rank them by price performance. We rank them by the number of stocks with bullish versus bearish power gauge ratings, the potential of the underlying stocks in that ETF to outperform the market. So right at the top, financials, technologies, and healthcare. So the potential is there in healthcare, but the price performance has been poor up until today. And at the bottom, those interest rate sensitive stocks, real estate, utilities, and consumer staples. And we're going to look at each of those three sectors briefly. The ones with more bullish than bearish power gauge ratings, and there are only three that have a better profile than the S&P, meaning the ratio of bullish to bearish is better than for the S&P, we would consider very bullish, and the ones down at the bottom, the three at the bottom, very bearish. So let's take a look at that financial sector that Tony talked about. Even before the election, our relative strength indicator had shown a personality change for financial stocks going back to late August. So financial stocks were anticipating a rise in interest rates because that helps the banks and the insurance companies. When you're in a zero interest rate environment, hard for the financial to lend out money and really leverage their balance sheet. And then after the election, as it became apparent that regulations were going to come off, which burden the financial stocks, the large cap and the small cap financial stocks, the banks and thrifts and some of the smaller insurance companies just skyrocketed. That ETF went from 1950 all the way to 2375, so better than a 20% gain, and it stayed strong with heavy money flow all the way up. Now on the left here are the stocks in the XLF, the Financial Select SPDR Sector ETF, with bullish power gauge ratings. So we're going to highlight, in addition to some of the major banks like Bank of America and Citicorp that are going to report earnings on Friday, along with JP Morgan, Morgan Stanley. I don't think Citicorp reports on Friday, but Bank of America and JP Morgan and Wells Fargo do. So let's look at Morgan Stanley, one of the great investment banks. And we see that we had an oversold buy signal. Now, all of these signals are on our website. Whether you're a visitor or a subscriber, we explain the basis for these signals. In this case, an oversold buy happens when the stock has a bullish power gauge rating, so you put the odds in your favor, and it makes an 8-day low as it gets oversold. and I owe this pattern to an old colleague, Larry Williams, who was my inspiration for creating Chaikin Money Flow. That buy signal came ahead of the earnings back in October, and there had been a pattern of 3 or 4 quarters in a row where Morgan Stanley reported better than expected earnings. If you remember back to the earnings factor in the power gauge, earnings surprise is one of the 20 factors. So they reported a positive earnings surprise. The stock moved up to a new high, and then after the election, it skyrocketed. And right here, we got another oversold buy signal about a week and a half ago when the stock dipped down under 42, trading at 43.50 today. Now, this has had a big run, and our upper volatility band is around 45. So what could you do to generate more income and perhaps make holding Morgan Stanley for the longer term more palatable? Well, Morgan Stanley has a yield of 1.87%. And Tony, why don't you describe this covered call strategy in Morgan Stanley and how it increases the yield and the annualized return by writing an out of the money call?
Yeah, so what you're seeing on your screen here is what you'll be able to get from OptionsPlay by typing in Morgan Stanley, clicking on the income tab. And what it will do is it will actually search for a suitable cover call opportunity. And I'll show you how you can actually set some predefined settings to meet your personal risk tolerance, as well as your how active you trade, so that OptionsPlay will actually find the cover call opportunity that best suits you. And in this particular case, what we're looking at is we're selling a March 45 cover call. So Morgan Stanley in this particular case is trading around 40, almost at 43. So you're selling a call that's about $2 out of the money. And you're going to receive, in this particular case, $216 in income for selling these 2 covered calls. And that comes out to be an annualized yield of about 14%. So that means that if you're able to consistently sell covered calls like this in Morgan Stanley throughout the year, you're going to increase your yield from Morgan Stanley of currently of only under 2% to over 15% in yield just by writing covered calls. So it's a very attractive way to consider adding yield to your portfolio at the same time, because as you consistently bring in an income stream month after month, you're going to be able to lower the volatility of your portfolio and provide some downside protection.
Now, the assumption here is that you bought the stock either when we got our buy signal, when it broke out, and then sort of went sideways in this 37 range for a few days, and that you're now very happy to sell the stock at a price higher than the market. So this disclaimer is very important, or this explanation. When you write covered calls to enhance your return, you're capping your ultimate opportunity. So regardless of how high the stock rises, the covered call writer's maximum payoff is the strike price plus the premium received. So in this case, with the stock at 43.89, writing a 45 call, getting $108 in premium, you're basically saying, I'm happy to get this 2.5% return in 2 months from the option writing, or sell the stock at 46.08, having bought it down in the 30s. So a very, very good strategy for people looking for income. Even though interest rates are rising, they're still low historically, and it's always nice in an environment where 10-year treasuries are yielding 2.3% to start looking at ways to get higher returns. Now, we noticed that technology was the second strongest group sector actually in terms of the power bar. Here's a chart of the XLK. You can see that it went to new highs. Remember when we looked at Qualcomm, which had given that money flow divergence, it was way down from its high of 70. And on the left, again, are the stocks in the technology large cap sector with bullish power gauge ratings. So let's zero in on Micron, which we've talked about on webinars for the last 3 months. Here's Micron, bullish personality change back in June, but the power gauge turned neutral. And it wasn't until late September when both the power gauge and relative strength were in gear. So there's your dynamic duo. The stock was 17, had a buy signal here, oversold buy on the way to 23. Now look what happened. We had that pattern again of a new high in stock, just as we did with Qualcomm, with negative Chaikin money flow. Now why did that happen? Well, it happened back here in September, and the stock went sideways for 2 months, but that was with the market. Institutions have been accumulating this stock. It's gotten expensive, and they're starting to take profits. So I'm going to show the next chart and then turn it back to Tony. And Tony, I know you've got a time commitment, so why don't you cover in this segment everything you want to cover about options play. But what I'm suggesting here is that you can protect yourself with Micron at 22.55 for potential decline back under 20 over the next month and a half by putting on a put spread. And Tony, if you want to start with that and then delve a little deeper into options play, that'll be great.
Sure, absolutely. So if we're talking about trying to buy some protection on Micron, once again, once you pull up the symbol, click on the options button, and what that will do is that will bring up options play. As you can see on the top of your screen, you have 3 selections on bullish, on bearish, or income. In this particular case, let's look at some bearish strategies to buy some hedges. So as you can see, I can buy an at-the-money put. So Micron's trading around 22.5. I can buy a 22.5 put for about $120, or I can lower the cost of buying that 22.5 put by at the same time selling a 19.5 put against that. So I'm still going to be able to get the upside if the stock goes lower, but it lowers the cost of buying this call option, this put option by about 25%. And what that actually does, that 25% goes to improve my return if Micron does go lower. In this particular case, if the stock goes down to 19.5, I'm going to make 150% return if I had just bought the put, which is a very common strategy for hedging purposes that most users will use because it's a very simple to understand concept. But if you do a little bit of work and look at these put verticals, there is a lot of benefit, because if the stock does go down in the direction you expect it to, instead of just hedging or getting 150% return, you're going to get a 206% return by lowering the cost of that trade. But more importantly, if let's say Micron doesn't go lower and stays exactly where it is, you actually will end up losing less money for this trade than you do with this one, because your losses for buying an option is limited to what you've paid for it. So that's really why this strategy here on the right gives you the higher options play score, because whether you're right, you're going to get a higher return, or if you're wrong, you're going to actually lose less money. So that kind of goes a little bit more in depth, telling you kind of how the options play score is derived. Now, more importantly, if the hedge costs you about $98, you can also take a look at the income tab. Because what you can also do at the same time while you buy that put spread is sell an out-of-the-money call and see if you can bring in some income to help finance buying that put spread. So what you can do here is you can type in how many shares of Micron you own. So let's say you own 200 shares of Micron. What it will do is it will automatically go out and find a cover call based on your personal settings, which you can set at the bottom, and you can set both time frame and risk tolerance. So every one of you that's on this webinar has a different time frame, because some of you are very active, some of you are long-term investors. So choose the time frame that suits you. And then in terms of risk tolerance, some of you may have owned Micron stock for a long time and you don't want to lose it, so you're going to be more on the conservative end of the spectrum. For those of you who may have just gotten into it, or maybe this is a high-flying stock that you don't care that you're going to lose, you might get a little bit more aggressive. So you can choose the time frame and risk tolerance, and options play will actually go and scan for the optimal cover call based on your criteria. So in this particular case, what we're saying is that if you sold 2 contracts of the February 10th 24.5 cover calls, which are about $2 out of the money or about 10% higher, you're going to receive $54 in income. So as you can see, I can buy some protection here for about $98, but I can even lower the cost further by writing a cover call against it and receiving 54 cents in income for that. So those are all different ways that you can potentially structure options to help protect yourself. You can do one or the other, or you can do both. This is really a great way, if you're long the stock, to buy some protection and help finance that by writing some cover calls. And you can do it all instantly without ever having to pull up a chain, picking a strategy, picking an expiration before you're able to see any analytics, because we provide that all to you immediately once you open up the widget.
Now, Tony, I know you've got another commitment, so I want to thank you as I continue and wind up the webinar here with a few more examples. So I'll take back the screen and hopefully we can do this again and get more specific about some of the strategies that OptionsPlay is particularly good at. So I'm going to go back to where we were in the deck and thank Tony for his participation and try and zip through some of the balance of the webinar with a very important new product announcement at the end of the webinar. So in 2017, defense is going to matter. Seattle's back in the playoff picture, and they've got a wicked defense because in a period of rising interest rates, you're in a stock picker's market, and that means you want to avoid the losers. So consumer staples, as we saw earlier, one of the sectors that we would expect to underperform in a rising interest rate environment have been underperforming since July with weak Chaikin money flow back here leading into the election. And on the left are a number of stocks in consumer staples that are bearish. And here you see those two stocks that Goldman Sachs put out a sell recommendation on late in the game, Procter & Gamble and Coke. Estee Lauder in the cosmetics business we're going to look at in a minute. And I noticed on that ticker tape that you were watching as we were waiting for the webinar to begin that Molson Coors, symbol TAP, was down about 2.5% today. So there's a continuing pattern of weakness in the beverage stocks, the cosmetic stocks, the consumer durables like Kimberly-Clark and so forth, General Mills and Kellogg. These are stocks to avoid in 2017. They don't do well in a rising interest rate environment. So here's Estee Lauder. You see all the classic signs of a classic Chaikin bear, power gauge bearish, relative strength to the market weak, institutions continuing to sell. It's a great company, but the stock's down from 98 to 78 and showing no signs of a bottom. Now, one more industry group we'll focus on, we've been looking at sectors, is aerospace defense. It's in the industrial sector, which has 22 bullish stocks and 1 bearish. And then just to reiterate what we looked at a minute ago, soaps and cosmetics and beverages, very weak power bars. We call this the power bar. More bearish than bullish stocks, there to be avoided. So let's look at one aerospace defense stock, Textron, making new highs. Again, money flow is bearish, so we might be thinking about taking profits. You had a personality change that was bullish in July with the stock at 39, with the power gauge bullish. It's moved up to 50 in anticipation that the Trump administration is going to rebuild the military. So let's say you're concerned about Textron up here, but you like it from the long term. Again, a covered call strategy. Here's a stock that has almost no dividend yield, less than 0.2%. But by writing a covered call with a $50 strike price, which is basically at the money, you can generate on 200 shares of stock $456 in income. That's a raw return on an option with 2 months to go. This expires on March 17th of 4.56%. That's an annualized return of 25%. So what you're saying is, I bought Textron on the way up. I'm willing to sell it at $50 strike price plus 228 or 52.28. But if it corrects, and the Chaikin money flow is telling me it's going to correct or have a hard time making new highs, then that premium is going to be all mine. If the stock closes below 50 in March, I pocket that premium and I can figure out if there's another call writing strategy to implement. So one thing I wanted to show you is how we find stocks. When I write my weekly market letter or in Chaikin Analytics, we have a screener. And in this case, value stocks have been outperforming growth stocks, reversing a pattern that's been going on for over 2 years. And when those patterns reverse, they tend to persist. So I screened our large cap value universe of 700 stocks to see which ones had bullish power gauge, bullish money flow, and bullish relative strength with a dividend yield of at least 1%. So looking for candidates for my buy list, for swing trading, options trading, or to put into my 401k plan. And I got 21 names. So in about 20 seconds, I filtered a universe of large cap value stocks from 700 down to 21 that met my criteria. Most of them are in the financial sector. JP Morgan. So now I'm going to show you, which reports earnings on Friday. I'm going to show you the newest product in the Chaikin product suite. We call it our discovery engine, which finds you stock ideas instantly based on a symbol that you put into the symbol box. So in this case, I took one of the stocks from that screen, JP Morgan, put it into the symbol box, and I got back 5 stocks with similar characteristics to JP Morgan, which has a very bullish power gauge. They're all in the major bank sector. And they're ranked by relevance, meaning by the strength of the similarity to JP Morgan. So key banks, PNC, Bancorp, Comerica, Bank America, and Citicorp. Potential candidates if you like the major banks. But I also have a slice in that output that shows me high dividend paying stocks. So PNC is an example of that. Here's PNC, which has made a huge upward move since the election from under 90 to 118. Everything looks bullish, but you could write a covered call, yet again, turning a stock with a dividend yield of 1.86% into one with an annualized return of almost 18% by writing an out-of-the-money 120 covered call that expires in February, taking in premium of $200 per 100 shares, turning a stock that's a decent dividend payer into one that's a big dividend payer under the assumption that I'd be happy to sell it, having bought it much lower at 122, with the stock currently selling at 117. In the event that we get further profit taking in the financials after the inauguration, then this option may expire worthless and you pocket that whole premium. Now, the second thing the discovery engine does for you is help you find swap ideas. So based on input from our head of product, Eric Smith, who seeded the discovery engine with a bearish insurance stock. Now be mindful, financial stocks have been strong, led by banks and insurance stocks. He put in the symbol RLI, which has a very bearish power gauge rating, and look what happened. We got 5 insurance stocks and real estate stocks with a bearish power gauge rating. So if you're actually bearish on the insurance sector, this is giving you other ideas, but it also gave you potential swaps. Let's say you owned RLI and we're looking for a stock with better potential. Well, it suggested 5 stocks. And then the 6th one was RE, which I've circled. And this is what RE looks like. Everest Reinsurance had a bullish personality change in October at 190. It's moved up to almost 220. And notice the 4 components of the Chaikin power gauge rating are all bullish. And analysts are raising their estimates. How do I know that? Right up here in our earnings alert window, estimate revision for the 4th quarter, analysts have raised their estimates from 310 a share to 329. So all the elements of Chaikin are embedded in this chart. This is the discipline we want you to follow. And the discovery engine is a breakthrough concept that uses the same type of technology that Spotify uses to help you find music or Netflix uses to help you find movies that you may like. We help you find stocks that you may like or swap out of based on the power gauge rating and 40 other factors that we're looking at under the surface. So Chaikin Analytics, as you've seen, has OptionsPlay, screener, earnings alerts, intraday charts, news, and now a very powerful stock discovery engine. John Malden, who's a macroeconomic guy with a following of 1 million subscribers to his free newsletters, has also embraced Chaikin Analytics just like John Carter has. They come from 2 different ends of the spectrum. One's a pure trader, the other's a macroeconomic big picture guy. They both see the value of the Chaikin power gauge rating and Chaikin Analytics. So what are your next steps to success in 2017? Number 1, reserve your free subscriber onboarding training session. If you're not a subscriber, consider subscribing now so you can get the benefit of this as we head into the inauguration. Start getting our daily and weekly newsletters called Market Insights. sign up for personal coaching sessions, and begin applying the Chaikin methodology to your options trading to make it more profitable, or to your 401k plan to help grow your retirement. Now, Chaikin Analytics for iPad and desktop is normally $1,950 a year for a 1-year subscription. As a webinar special, we're taking $200 off, reducing the price to $1,750. Go to chaikinanalytics.com/options. You'll get to our fulfillment page with the discount pre-populated, and this offer expires Friday, January 13th. You can also call sales at the number on your screen. And if you want a free demo of the stock discovery engine, by all means, 877-697-6783 to arrange a demo. Now, added value, these small group tutorials, which really are so critical to teaching you the features in Chaikin Analytics, how to use them and why they're important, is part of our process. Joe Bacella and his team, Michelle, Josh, they're there to help you get up and running and take advantage of the insights, the profit potential inherent in the Chaikin methodology. My colleague John Schlitz writes a morning market commentary, comes into your inbox before the opening, so you find out what happened overseas, overnight, yesterday, and what his expectations are for the coming trading day, and then my weekly market insights with a specific bullish or bearish recommendation and my thoughts on the market going forward. Now, as a fast action bonus to try and encourage you to really take advantage of Chaikin Analytics as quickly and expeditiously as possible, we're going to take an additional $100 off the cost of Chaikin Analytics if you subscribe by midnight tonight, reducing the price to only $1,650. ChaikinAnalytics.com/options. And then one final inducement, probably the best offer of the night. If you subscribe by midnight tonight, we'll enroll you for free in our Options Academy course. The next one is February 1st. Joe Bacella teaches a 3 or a 4-hour course on option strategy using Chaikin Analytics and OptionsPlay. The normal fee to take the course is $700, so we're adding that as a fast action bonus to that $300 discount. Again, reducing the price from $1,950 to $1,650, and then giving you the options training you need, whether you're a novice or an experienced options trader. The feedback on Joe's webinar is very valuable, really pointed me in the right direction. And with that, I'd like to thank Tony Zhang, turn it back to Joe to wrap up the webinar. And Joe, you're going to put up your screen with the fulfillment page. You're one step ahead of me, as you usually are.
Awesome. Well, Mark, thank you so much. And also a late thank you to Tony Zhang as well. Just as Mark was mentioning, there's really no better time to become a subscriber to Chaikin Analytics. Mark's offer is available at chaikinanalytics.com/options, which is also available in your chat link. So if you look in your chat window right now, you'll see this link as well as a number you can give us a call at. I saw there were a few people chatting that they're going to give us a call as soon as the webinar is over. Our full staff is here and available, so don't be shy. Make sure to give us a call as well. Or, of course, you can self-serve. Go to chaikinanalytics.com/options. And after all, I think that's a pretty good theme for the webinar today, just like Tony mentioned at the beginning. We want to empower you. We want to put you in a position where you can succeed in the market on your own. And no better time to do this. It's only January 10th. The year is just beginning. No better way to get off to the right start with your options strategy. We covered swing trades today. We covered calls. There's a variety of other strategies that OptionsPlay caters to, and we cover all of those during our twice weekly option sessions, as well as our Options Academy course, which if you subscribe by tonight, you will have access to as part of your subscription. So we'd love to have you join us. Our next onboard session is tomorrow afternoon. As soon as you get in the door here, you'll have access to the program within just a few moments. And of course, we'll love to have you on the onboard session tomorrow to make sure you get up and running as soon as possible. So on behalf of the entire Chaikin Analytics team, we want to thank you so much for spending your afternoon with us. In the meantime, have a wonderful evening, and we'll see you tomorrow on our onboard session. Thanks.